Welcome to My Steel Commodity Flux, the podcast where we track the trends, turns, and turbulence shaping global commodity markets. I'm Nikki Fu, Commercial Director at My Steel Global. China's LNG prices declined again from July 24th to 30th, with the average ex-plant prices, average market prices, and receiving terminal prices all moving lower. On the surface, it looked like another bearish week for the market. But beneath the price action, the fundamentals were beginning to tell a different story. The domestic production eased as maintenance reduced output. Plant inventories declined instead of building. Demand improved as lower prices attracted buyers back into the market, while LNG sales volume by truck at plant also increased. Taken together, these developments suggest that the market may be approaching an inflection point, even if prices have yet to reflect it. Joining us today is Gary Gao, Gas and LNG Markets Research Lead at MySteel Oilchem. Gary, after several weeks of persistent price weakness, are we finally seeing the market shift toward a new phase?
I think that's exactly what's happening. When examining the underlying market fundamentals, we see production declining, plant inventories edging lower, and demand gradually recovering. More importantly, production costs are beginning to move higher. Taken together, the market is moving away from a phase dominated by oversupply concerns and toward one where tightening supply and rising costs are becoming the primary drivers of prices.
Let's start with supply. China's LNG production declined last week, but the reduction wasn't particularly large. Was it enough to change the market balance?
By itself, the decline was relatively modest. China's domestic LNG production totaled 563,700 tons last week, down 0.7% from the previous week. However, the reason behind that decline is more important than the number itself. Several LNG plants suspended operations for maintenance, while others reduced operating rates. Last week, 2 additional plants entered maintenance, removing around 1 million cubic meters per day of production capacity. More importantly, this trend is expected to continue. Some upstream gas fields have scheduled maintenance in August, which means feedstock gas availability for LNG production is likely to decline further. In other words, last week's lower production could mark the beginning of a tighter domestic supply environment rather than a temporary fluctuation.
Yet prices still moved lower. Normally, tightening supply would be expected to lend support to prices. Why didn't that happen last week?
The market remained cautious last week despite some improvement in domestic fundamentals. Production declined only slightly, while demand recovered at a gradual pace, leaving limited momentum for prices to move higher. At the same time, international spot LNG prices continued to soften. Easing geopolitical tensions in the Middle East reduced supply concerns, while relatively subdued demand and elevated inventory levels in Northeast Asia also weighed on the global market, limiting cost support for China's LNG prices. As a result, ex-plant prices, market prices, and receiving terminal prices all continued to decline, even though the domestic supply-demand balance had begun to tighten.
Demand, however, seems to tell a different story. Lower prices appear to have encouraged more buying.
Yes, and that's one encouraging development last week. China's LNG demand increased by 1.6% compared with the previous week. Lower LNG prices improved its economic advantage, particularly after diesel prices moved higher, encouraging a recovery in logistics demand. At the same time, more attractive ex-plant prices encouraged downstream procurement, leading to a gradual increase in LNG sales volume by truck at plant. The demand side has responded to lower prices exactly as the market would hope. We could say that the underlying consumption remains resilient, and if expectations of higher prices become more widespread, buyers may become even more active rather than waiting on the sidelines.
And inventories also moved in a more supportive direction.
They did, although the picture differs between plants and receiving terminals. Plant inventories declined by 1.7% to around 610,000 tons, reflecting lower production and stronger demand last week. Another inventory draw is expected this week. Receiving terminal inventories, meanwhile, increased last week as previously contracted cargoes continued to arrive. However, with fewer LNG cargoes expected to reach, those inventories are also likely to edge lower during the week, so supply is becoming slightly tighter from 2 directions. China's domestic production is easing, and imported arrivals are also declining. Neither change is dramatic on its own, but together they reduce the likelihood of inventories building again over the near term.
Another figure that caught my attention was plant profitability. Margins deteriorated quite sharply last week.
That's right. Average production margins at sampled Inner Mongolia LNG plants fell to around minus 152 yuan per ton, a decline of 124 yuan from the previous week. However, I don't expect margins to remain at these levels for long. Feedstock gas auction prices for the first half of August moved higher, pointing to another increase in production costs. While that will raise costs for LNG producers, it should also strengthen cost support for China's LNG prices. As prices recover, plant margins are expected to improve despite higher feedstock costs.
So when we put everything together, it feels like the market is becoming increasingly supported by fundamentals, even though prices haven't reflected that yet.
Last week's market wasn't defined by stronger demand or lower supply alone. Instead, it was the combination of several gradual changes occurring at the same time. Production moved lower, demand improved, plant inventories declined, imported arrivals eased, and production costs are set to increase. Individually, none of those developments would necessarily reverse the market. Together, however, they point toward a tighter balance than we've seen in recent weeks. That's why market expectations have started to shift. Instead of focusing on how much further prices could fall, attention is increasingly turning to how quickly higher costs will be reflected in China's LNG prices.
Finally, Gary, looking ahead, what are your expectations for China's LNG prices during the week, and what will be the key drivers shaping the market?
We expect China's domestic LNG prices to stabilize and rebound this week, primarily supported by rising production costs. Higher feedstock gas costs, together with reduced upstream gas availability due to scheduled maintenance, are likely to constrain China's domestic LNG production. At the same time, expectations of higher prices should encourage downstream buyers to secure volumes earlier, supporting stronger demand and further inventory drawdowns. Although production costs will continue to rise, stronger LNG prices are expected to improve plant margins. The market appears to be entering a new phase, where pricing is increasingly driven by rising costs and tightening supply rather than persistent weakness in demand. For this week, the average ex-plant LNG price is expected to rise to around 5,400 yuan per ton, with the average market price rebounding to around 5,800 yuan per ton.
Gary, thank you for sharing your insights, and thanks to everyone for listening. If you'd like to follow these developments in more details, the full analysis and data behind today's discussion are available through MySteel Oilchem's latest China LNG Market Weekly Report. For more information, please visit mysteel.net or contact us at inquiries@mysteel.com. Thanks for listening to MySteel Commodity Flux. If you found today's episode helpful, be sure to subscribe for more analysis on global commodity markets. Until next time, keep tracking the flows.